SJ Fibonacci here, and welcome to lesson 1 of 438's Forex trading course. Today, we'll be diving into the exciting world of foreign exchange trading. But before we get started, let me just give you a quick rundown of the objectives of lesson 1 in this course. Right? So our first objective is to introduce the concept of Forex trading, define a market and its components, including price, buyers, and sellers, highlight the existence of multiple financial markets, provide a clear definition of the Forex market, focusing on currency trading, explain how exchange rates function using examples like the Euro USD pairs, demonstrate how to read and interpret exchange rates for foreign prices, for Forex prices, discuss how traders make profit in Forex by buying low and selling high, explain the decision-making process in Forex trading, like how do you decide what to trade, what to buy, what to sell, including the methods that we use, including technical analysis and fundamental analysis. We'll also be delving into the various participants in the Forex market. And last but not least, provide some context on the size of the market, its now readily accessibility to retail traders like myself and you due to technology advances, and Forex brokers. Now let's get straight into it. So before I can define what the Forex market is, I first want to define some key terms. So Forex is actually short for foreign exchange, right? And a market, what is a market? So in any market, buyers and sellers come together to exchange goods or services at a mutually agreed upon price. In the financial realm, markets operate similarly, but with financial instruments like currencies, stocks, and commodities. So essentially, a marketplace, whether it's a physical or it's virtual, but it's a place where buyers and sellers come together to exchange goods and services, right? So the Forex market, as a definition would have alluded to, the Forex market is a market where people come to exchange currencies. What I want you guys to pay attention to in that definition is the part about the mutually agreed upon price. So just stick up in there and bear it in mind. Now, let's zoom in on the Forex market. So Forex market, short for foreign exchange, as I said earlier, is where currencies are traded against each other. For example, the GBP USD pair, right, where the price represents the exchange rate between the US dollar and the British pound, right? So in the foreign exchange market, the price is actually represented by the exchange rate. That's very important. The price is represented by the exchange rate. Understanding exchange rates or Forex prices is crucial. Take the Euro USD pair as an example. If the Euro USD pair is trading at $1.13, it means €1 equals $1.13 USD dollars. Now let's explain this in the context of a market. If you go to the market and you want to buy €1, the mutually agreed upon price to buy that euro would be $1.13 USD cents. It is going to cost you $1.13 USD cents to buy that €1. Now, if you look at how a pair is represented, the currency that follows the slash is what we call the base currency. And this is the currency in which the exchange rate is quoted. Let's take as an example Euro USD. USD is the base currency here, and as such, the price is actually quoted in the USD currency. And that's also very, very important to note. And a more relatable example for us Jamaicans is the USD JMD exchange rate. We actually don't call it that. We call it exchange rate for short. But what it actually is a Forex pair where the base currency is JMD. So that $158 that it takes to buy one USD, that is our exchange rate, and it's quoted in JMD because JMD is the base currency in that Forex pair. Now that we understand that the exchange rate is the price, how do we make money from this? And the answer to that is we make money from fluctuating prices. So within any market, the price is never constant. So there are market forces that determine what the price is. Market forces like demand and supply of that particular currency. Those are some of the factors that impact price. Now, I like to give the example of there's another a market. Let's say that you go to a market that sells potatoes. You have the hunch that at some point the potato market there's gonna be a scarcity in potatoes, right? So you go to the market on Monday and you buy, and at the time potatoes are being sold for $10 a pound, right? And you end up buying 10 pounds of potatoes because you believe that on Friday there's gonna be a scarcity and the price of potatoes are going to increase to $12. So you go to the market on Monday and you buy that 10 pound of potatoes, which would have cost you $100. And then now, come Friday, there's a scarcity, and that scarcity drives the price up to $12. And you then decide, you know what, I'm going to sell my 10 pounds of potatoes I bought on Friday for that $12. Now your $100 has now turned into $120. And the profit that you'd have made in that would be $20. And that's exactly how you make prices, how you make profit in the forex market. So a key thing for you guys to remember is that you buy low and you sell high, and that is it. Regardless, and again, I go into details. I go into details for it, but just remember that the way how you make money with anything is buying at a lower price and selling it at a higher price. In our particular example, we would have stated that we had a hunch that there would be a scarcity and the price would have gone up on a Friday. But in reality, we can't trade off hunches, right? So there has to be a process that determines whether we sell or buy, or determines the direction in which we trade, right? And there are two main methodologies that we use to determine that. There's technical analysis and there's fundamental analysis. Now, technical analysis is pretty much using the historic data on the charts, historic prices to make a prediction on where you think the price will be going next. Now, the fundamental analysis now are more around like the macroeconomic variables and the decisions by the government and geopolitical affairs, that there's a war, those kind of things. Those are the things that drive the movements of prices within the market. Of course, we'll go in detail in those two methodologies later on in the course. But for now, what you need to remember is the decision making process or the decision making methodologies. Those are two that we will be focusing on in this course. Now, before we continue, let's just do a quick recap on what we've covered so far, right? So we have confirmed that the Forex market is a place where people come to buy and sell currencies at a mutually agreed upon price. And this price is what we know as the exchange rate. We've also determined how traders make money from the Forex market, right? We make money from the fluctuating prices. The prices are never constant. We buy low and we sell high. And we also determine how we decide when to buy and when to sell, what to buy and what to sell, right? And we determine this by using a combination of technical analysis and fundamental analysis. Now, now let's dig a little deeper into the different participants in the Forex market and where you fall as a trader. The Forex market is vast, with participants ranging from central banks and commercial banks to hedge funds and retail traders like us. While retail traders can't move the market individually, collectively, we contribute to the market liquidity. And what I want you guys to pay attention to is the latter part of that statement around retail traders not really being able to really move the market, right? The big boys are the ones who move the markets, like the central banks and the hedge fund boys and and the commercial banks, right? They are the guys who really move the market. Retail traders are pretty much at the bottom of the food chain when it comes to the participants within the market and the contribution to the market. So we do contribute to liquidity, but at a very small percentage. And we really and truly follow the liquidity of, and liquidity here means just money in the market. Money that's in the market, that's flowing around in the market, right? We really follow the liquidity of those big boys. So that's something that I definitely want you guys to take away from this. So you hitting buy or sell, or you deciding to buy and sell at this point, really not, it's a drop in the ocean in terms of liquidity of the market, which will allow us to segue into the size of the Forex market. The Forex market is the biggest financial market, right? Earlier in the course, I mentioned that there is a commodities market, there is a stock market, right? There is a futures market, like, and those other types of financial instruments. But of them all, the Forex market is the biggest market. For comparison, I think the liquidity in the Forex market ranges upwards or north of 5 trillion when compared to, for example, like New York Stock Exchange, where it's around north of like $20 billion. So that's to give you a context in terms of how big the Forex market actually is. I know you're probably wondering what is the significance of mentioning the size of the market in terms of liquidity at 5 trillion US dollars a day. What's the significance of mentioning that? And let me tell you why. That liquidity is what allows you to get an instant buyer for a currency when you sell it in the Forex market, right? There's so much money going around and there's so much demand that as soon as you decide to sell, there's a buyer on the other end. And that is where and that's the significance of mentioning the liquidity. You have instantaneous buyer or seller at a particular price or liquidity level, right? And that is one of the major advantages of trading the Forex market, right? You guys will see how we actually go about executing trades and stuff like that. But as soon as you execute a trade and as soon as you decide to close a trade or close a position, the liquidity is what allows you to have that instantaneous settlement and closure of that particular trade or transaction. Now you're probably wondering how an individual trader like myself, like you and myself, is able to take advantage of these fluctuation in prices when the prices are so small, right? And just let me tell you, let me give you a brief history of what Forex trading used to be. Forex trading actually used to be reserved for the same big boys I just mentioned, right? Because it would require a whole lot of money. You'd have to buy a whole lot of the currency in order for the change in the price to be significant and profitable for you, right? So now I mentioned in our potato example where buying 10 pound of potatoes at $10 and then selling it back at $12 would make you $20 profit, right? But the change in the currency prices are so small, so small. So it's not a $10 change. It's a decimal change, right? So in order for the difference in price to be profitable, you have to be buying thousands of units of the currency. Now you're wondering, where would a individual like me and you get that kind of money, right? And that's where the Forex brokers come in, right? So the Forex brokers and the emergence of Forex brokers, these didn't exist back in the past, right? So Forex trading was only reserved for a set of people, like the banks, the big boys, who had the money to be able to buy thousands of units of a currency for the change in price to be significant and profitable to them. Now we have an emergence of brokers who offer customers leverage. And what leverage really is, pretty much is almost if you're borrowing the money from a broker in order to execute a transaction, right? So you deposit. So let's say you deposit $10 and your leverage and your account has a leverage, and the leverage in your account is 1 to 1,000. It now means that your $10, right? Your broker would give you access to $1,000 to be able to execute trades on the market. And of course, you have to pay the broker fee to get access to this leverage. So it's almost as if it's a multiple of the money that you've entered, which is why it allows you to start trading with as low as $10. Right? Back in the day, you would not be able to do that. But the emergence of brokers and technology, you're able to take advantage of those things. We're gonna delve further into leveraging or leverages and the change in the price of currencies. I mentioned it's so small. I mentioned it's very small. I'm going to delve into how we determine that change, how we measure that change in the subsequent sections of the course to come. But if you have made it this far, I want to congratulate you for completing the first lesson in our course. And stay tuned. There's a whole lot more to come. And don't forget to like, share, and subscribe, and get this knowledge to somebody who you think will benefit from it. Until next time.